Margaret thought the letter was a mistake. She was 71 years old, lived in Ohio, and had done everything she believed retirement experts recommended. Her home was paid off. She had nearly $420,000 in retirement savings. Every Medicare premium had been paid on time. Then, one envelope changed her year. Her monthly Medicare premium was about to jump. By the end of 12 months, she would pay nearly $4,800 more than she expected. She hadn't changed health plans. She hadn't received extra medical treatments. She hadn't broken any law. One decision she made 2 years earlier quietly raised her Medicare costs. The worst part? She didn't even know it had happened until the bill arrived. That same hidden rule surprises thousands of retirees every year. If you're collecting Social Security, approaching Medicare, or already enrolled, understanding this rule could help you avoid an expensive mistake. Let's see exactly how it works. Margaret's story actually began long before the letter arrived. She retired from teaching at age 69 after nearly 4 decades in public schools. Her pension covered most monthly expenses. She also received Social Security and occasionally withdrew money from her IRA. Life felt comfortable. Her husband had passed away several years earlier, and she wanted to simplify her finances. Then, her financial advisor suggested converting a large portion of her traditional IRA into a Roth IRA. The advice wasn't bad. For many retirees, Roth conversions can reduce future taxes. Margaret converted almost $240,000 in 1 year. She paid the income tax. She felt relieved. Then she forgot about it. 2 years later, Medicare remembered. Here's why. Medicare doesn't simply look at what you're earning today. For many beneficiaries, Medicare Part B and Part D premiums are based on something called your Modified Adjusted Gross Income, often shortened to MAGI. Even more surprising, Medicare generally uses your tax return from 2 years earlier. That's called the 2-year lookback. If your income during that earlier tax year crossed certain thresholds, you may owe what's known as the Income-Related Monthly Adjustment Amount, or IRMAA. Think of IRMAA as an income-based surcharge added to your Medicare premiums. It's completely legal. It's built into Medicare. But many retirees don't realize one unusually high income year can affect premiums much later. Margaret wasn't paying more because she suddenly became wealthy. She was paying more because of a financial decision made years before. But that's not the biggest problem. Many retirees accidentally trigger IRMAA without realizing which transactions count as income. Consider Robert. He was 68 and lived in Arizona. After retiring from an engineering company, he decided to sell a rental property he had owned for 20 years. The sale generated a substantial capital gain. His accountant correctly reported everything. Taxes were paid. Robert thought the matter was finished. 2 years later, both his Medicare Part B and Part D premiums increased. The property sale had pushed his income high enough to trigger IRMAA. The gain happened once. The Medicare surcharge lasted an entire year. That's why timing major financial moves matters so much during retirement. Here's where many people get caught. Not every dollar entering your bank account counts toward Medicare income, but many retirees assume that's true. For example, qualified Roth IRA withdrawals generally aren't included in taxable income. Neither are many life insurance death benefits. However, taxable IRA withdrawals, Roth conversions, large capital gains, taxable pension income, and certain investment income can all affect your modified adjusted gross income. That's why two retirees with similar lifestyles can pay completely different Medicare premiums. It's not always about how much cash they spend. It's often about what appears on their tax return. Susan from North Carolina learned this lesson the hard way. She retired from nursing with about $610,000 in retirement savings. Her daughter was buying a first home. Susan wanted to help. To raise cash, she sold several highly appreciated mutual funds held in a taxable brokerage account. She happily handed her daughter the down payment. The family celebrated. Nearly 2 years later, Susan opened her Medicare premium notice. She couldn't understand why her monthly costs had increased. Her generosity wasn't the problem. The taxable capital gains were. She still didn't regret helping her daughter. She simply wished someone had warned her about the Medicare consequences beforehand. Almost nobody realizes another important detail. IRMAA isn't a permanent penalty. Your premiums are generally reassessed each year using the available tax information. If your income later falls below the applicable threshold, your premiums may also decrease. That means one expensive year doesn't necessarily follow you forever. Still, paying thousands of dollars more for 12 months can seriously affect a retirement budget, especially when inflation, insurance, groceries, and utilities are already costing more. Now here's something that surprises even experienced retirees. Certain life-changing events may allow you to ask Medicare to reconsider an IRMAA determination. For example, retirement itself, marriage, divorce, the death of a spouse, or the loss of income-producing property due to circumstances beyond your control may qualify in some situations. If your income has genuinely dropped because of one of these events, you may be able to request a new determination instead of waiting for future tax returns to catch up. This isn't automatic. You usually need to contact Social Security and provide supporting documentation. Many people never ask. As a result, they continue paying higher premiums, even when their financial situation has changed dramatically. The story gets worse. Some retirees unknowingly stack multiple income events into the same tax year. Imagine Jim from Florida, age 73, recently widowed. He sold a vacation home, converted part of his IRA, cashed out company stock, and withdrew extra retirement money to renovate his primary residence. Individually, each decision made sense. Together, they created one unusually high income year. His federal tax bill increased. Then, 2 years later, his Medicare premiums increased as well. Nothing illegal happened. No one made an accounting mistake. The timing simply worked against him. This is where planning becomes far more valuable than reacting. Before making major financial moves, ask yourself several questions. Will this increase my taxable income? Could I spread the transaction across multiple years? Would smaller withdrawals accomplish the same goal? Should I discuss the timing with a tax professional? Sometimes delaying a transaction by a few months can produce a completely different outcome. The decision isn't always about avoiding taxes. It's about understanding every consequence connected to retirement income. Linda, age 70, offers a different example. She and her husband wanted to convert part of their traditional retirement accounts into Roth IRAs. Instead of converting everything at once, they worked with their advisor to spread conversions over several years. Each conversion remained within income levels they felt comfortable managing. Their tax bills stayed more predictable. Their Medicare premiums remained easier to control. The total amount converted was nearly the same, only the timing changed. Sometimes patience saves more money than speed. Another area worth watching involves required minimum distributions, often called RMDs. Once retirees reach the applicable age under current law, many traditional retirement accounts require minimum annual withdrawals. Those withdrawals are generally taxable. Combined with pensions, Social Security, investment income, or property sales, they can increase taxable income enough to affect Medicare premiums. That's one reason retirement planning doesn't stop after you leave work. Your income sources continue interacting with one another every year. Here's another common misunderstanding. Some retirees think declining Social Security automatically reduces Medicare costs. Not necessarily. Medicare premium calculations generally depend on the income reported on your tax return, not simply whether you've started Social Security benefits. Likewise, spending less money during retirement doesn't automatically lower Medicare premiums. Again, taxable income is the key factor. That's why understanding the tax side of retirement can be just as important as understanding investments themselves. Michael from Colorado experienced something many families face. After his father passed away, Michael inherited a traditional IRA. He carefully followed the withdrawal rules. However, the required distributions increased his taxable income. Combined with consulting work, he still enjoyed part-time. His income climbed much higher than expected. His Medicare premiums followed. He later admitted the premium increase wasn't financially devastating. What frustrated him most was being surprised. A simple conversation with his financial team beforehand could have helped him prepare. Let's pause for an important reminder. Higher Medicare premiums don't necessarily mean you've made a bad financial decision. Selling appreciated investments may still be worthwhile. Completing a Roth conversion may still provide long-term tax benefits. Receiving higher income isn't a problem in itself. The goal isn't to avoid success. The goal is to avoid unexpected surprises. Understanding how today's decisions affect Medicare 2 years later gives you more control over your retirement plan. Here's a practical habit that can make a real difference. Each autumn, before the end of the tax year, estimate your projected taxable income. Include pension payments, IRA withdrawals, capital gains, part-time work, investment income, any planned Roth conversions. Then compare the total with current Medicare income thresholds. If you're close to crossing into a higher IRMAA bracket, it may be worth discussing your options with a qualified tax or financial professional. Sometimes modest adjustments can prevent much larger premium increases later. One more point deserves attention. Financial decisions rarely exist in isolation. A move intended to reduce future taxes could temporarily increase Medicare costs. Selling investments could affect both taxes and premiums. Large withdrawals may influence multiple areas of your retirement finances simultaneously. Looking at only one consequence often creates another. The strongest retirement plans consider the entire picture. Let's review the biggest lessons from Margaret's story. First, Medicare premiums for many beneficiaries are based on income reported 2 years earlier. Second, large taxable events such as Roth conversions, capital gains, and significant retirement account withdrawals may increase future future premiums through IRMAA. Third, higher premiums often result from timing rather than mistakes. Fourth, some major life-changing events may allow you to request a new IRMAA determination if your income has genuinely fallen. Finally, planning major financial decisions before they happen is usually far easier than fixing expensive surprises afterward. Retirement should bring confidence, not confusion. The more you understand how taxes, income, and Medicare work together, the more prepared you'll be to protect your savings. Before making your next major financial decision, ask one simple question. How might this affect my Medicare premiums 2 years from now? That single question could save you thousands of dollars. If you found this helpful, take a moment to like the video. Subscribe for more practical retirement guidance on Medicare, Social Security, taxes, and protecting the savings you've worked a lifetime to build. And share this video with a friend or family member. One conversation today could help someone avoid a very expensive surprise tomorrow.